The broadcast is now starting. All attendees are in listen-only mode.
All right. Good afternoon. Thank you all for joining us for what is the May, now June 2nd version of the 12 Points broadcast. We're really excited to have with us today John Harpoosian, partner at Pastor and Harpoosian in Cranston, Rhode Island. John is going to be spending time today talking to us about some proposed changes to the world of estate and trust and gift tax laws. Really important stuff, timely information. So thanks, John, for joining us. Really appreciate it. First off, thank you.
You're quite welcome.
And
happy to be here.
Good, and we're happy to have you. So for those of you that don't know John, and that might be a good amount of you, trusted and estate attorney, specializes in all manner of intergenerational wealth transfer, business owners, high net worth families, does a lot of complex planning strategies, really talented, focused in the world of trust and estate, somebody that is a good friend of the firm, and I'm really excited to have him on this presentation with us today. This is some really important information, as I said. There's some real in the weeds sort of stuff. We're going to try to give you as much information as we can. Know that there'll be, I suspect, and John suspects, that there'll be some follow-up questions. We'll leave some time to answer them as best as we can. And as always, we're recording this and we'll share it with everyone. So to the extent that there's anything that we might not have addressed in sufficient detail for you, by all means, please reach out to either John directly, and you can see his contact information here on this screen. His phone number is 401-455-9800. The email is john@ph-estplan.com. Or certainly you can reach myself, Chris Cahill, at 12 Points at 978-318-9500. And my email is chris@12points.com. So without further ado, let's get right into it, John. So, the world of the Green Book, let's talk about what it is and the proposed top of the trees changes here, and we can get into the specifics.
Yeah, sure. Thanks, Chris, and thanks for having me on for today's broadcast. In my mind, the most important thing to give to our clients is certainty. I always like to be able to say, yes, this is exactly what the rules are, and here's how you've got to navigate them. In these uncertain times that we're in right now, I can't even tell you that we have any certainty as to what the rules are going to be, what they are now, and how to prognosticate into the future. But we're going to take a shot at it today. So even though I wish there were certainty, there really is not. There's a lot of uncertainty in many aspects of today's world. But obviously the president has laid out some plans that would really shock the tax system if they became law. And this isn't anything that's dramatically new, although this year's changes are very different from the things that the president and the administration proposed last year. There are a few things. And for those of you who have seen or heard me speak before, I've given lots of presentations when there's changes of administrations on what we might expect out of a new administration. And last year was no different. President Biden laid out a very ambitious agenda, and of course none of it passed. It was a very complicated web of proposals. Many of those things that saw the light of day ended up being seriously debated, but in the final analysis, nothing passed. And I know the media likes to focus on one particular United States senator, and I can tell you straight up that Senator Manchin from West Virginia was not the sole reason why nothing passed last year, and is not the sole reason why maybe none of these things might not pass this year either. So at any rate, we'll talk about these proposals and how they got here. First off, every administration, they release in the early part of the year, and this year it happened to be on March 28th of 2022. The Department of the Treasury released what we all refer to as the Green Book, which is more definitely known as the general explanations of the administration's fiscal year revenue proposals for 2023. And so we'll go over those today. We'll definitely, have a little discussion about the likelihood of passage. I've given up a long time ago trying to prognosticate as to what the law is going to be, but there are always some defensive moves that can be made in light of things that might happen. So that's pretty much where we are today, Chris. Is that it's going to be just an outline of what we think might happen. But to first do that, we should go over the 2022 Green Book proposals.
Perfect.
And essentially, and if we could go to the next slide, that would be great. So there are 5 main portions of this year's Green Book that really affect us on the estate planning side. And the first one that, I think is really a very, very difficult thing to administer and enforce, but is capital gains would be treated as realized when somebody dies or when they receive a gift. So, like, for example, today, if, one of you in the audience were to give Chris a gift, and let's say you gave him appreciated stock of $1 million, and the stock was really had zero basis, let's say, and you made this gift to him, and let's say you had used up your exclusions. I'll come back to that in a minute. Then what you would end up doing is actually paying capital gains tax as if you had sold it rather than gifted it to Chris. And you, as the donor, you're the one who's the one that's going to be paying this tax.
It's
a very, very different departure.
Right. That's just a totally different world than what we're living in now, and
Oh yeah.
So many people have been planning on, as we've discussed, John, the sacrosanct rules as it relates to planning in people's minds of the step up in basis at date of death. The idea that that's going to be removed would throw many a plan into a tailspin. So it is definitely one of the most disturbing proposals. I don't know how it gets administered either. But let's proceed and talk about some of the other similarly disturbing proposals.
Yeah. So last year you might have recalled Senator Sanders and Senator Warren talking about this, wealth tax. So this year it actually found its way into the Green Book. So there'd be a minimum tax on all persons whose wealth exceeded $100 million in value. So, that requires an annual valuation of everything. So, I guess if you were looking for a career to get into, you might say, well, I'm going to be an appraiser because, everybody who's really wealthy is going to need to appraise their property every single year in order to pay this tax, which, creates a whole business that, doesn't exist right now. And again, makes it difficult to administer. So we'll see where that goes, but I'll come back to more of the details in a few minutes. The next big thing that's in the Green Book is a modification of how we treat grantor retained annuity trusts, which are known in the vernacular as a GRAT, and intentionally defective grantor trusts. And
two of my favorite
for
strategies.
purposes of our discussion. Yeah, absolutely, Chris. So we use them every single day, and I'm sort of assuming that a little bit of knowledge on behalf of the audience, but I'll come back to that and describe them a little bit more. So that's another big thing that they've targeted, and then almost every trust that I do is a generation skipping trust. And the reason why I like to do that is because I like to lock in our exemption and have these big trusts pass from generation to generation to generation with no transfer taxes being paid, once we've allocated our original generation skipping transfer tax exemptions to the trust. Well, yeah, this part of the Green Book says no, we're going to limit that. You just can't have these multi-generational dynastic style trusts anymore, and I'll come back to those details as well. And then the next thing that's in the Green Book, which affects trusts and estates, is actually how tax administration is conducted, and so there's some rules on that we'll go over. The good news is that for much of this, it's not retroactive. Everything really begins on January 1st of 2023 if it becomes law. I think it's also very fair to talk about what was included in the past but is not included in these proposals this year.
Right.
And actually, I wish that you could see me right now, because as I'm saying this, I'm standing on top of a table and waving my arms, because this first one is really important. We have been constantly talking about the possibility of a reduction in the estate and gift tax exclusion, which, as I'm sure almost everybody knows, that is $12,060,000 per person. And that is indexed to inflation. So it changes every January 1st. And of course, it's going to go up by a lot on January 1 of 2023, because 2022 is going to be just an extraordinary inflationary year. Mm-hmm. And so this is the current law through December 31st of 2025, at which time the law is scheduled to revert to what it was before the 2017 Tax Act, which took effect January 1st of 2018, became law. So we'll see, but this is a major thing that sort of gives us comfort in saying, well, at least for the next few years, we know what the rules are going to be, because there's been no discussion of a reduction in that estate and gift tax exclusion.
And I'll simply add there, with regard
the other thing,
with regard, if I may, John, with regard to that topic there of the estate tax exemption, that was such a huge motivator for clients last year and the year before to take action and plan, because there was that fear that there was going to be a reduction back to pre-2017. So this is excellent, because it gives us the ability to look out a couple of more years with some certainty of planning. But again, absent any changes, we are going to revert back in January 1st, 2026 to the prior exemption amount. So we know that eventually that's going to happen, absent a continuation of current law. But this is a big deal here for sure, that it's not included in this Green Book proposal.
It sure is, and that's why I thought it was worth mentioning that this was not included, because it was prominent in last year's Green Book. So what else? So last year's Green Book also targeted irrevocable life insurance trusts, and essentially what they were targeting last year is to say, well, we're going to tax any grantor trust, and 99% of life insurance trusts are grantor trusts. And so they've backed off of that. And I I think the financial services lobby explained to Congress that, hey, look, this is a really bad idea. You're trying to encourage people to be financially astute and aware of themselves, and you take away the irrevocable life insurance trust, and you're going to take away a valuable tool for savings for families.
It would have been a nightmare.
So that's been, yeah, so that's been taken out and is not part of this year's proposals. And then the other thing that's something that we use all the time is a family limited partnership. It's a very common estate planning technique that we dump assets into essentially a business for purposes of reducing the value of family owned assets. So what they proposed in the past, but not this year, is to hold the value of those non-business assets that would be in such an entity as the value of the entity itself, instead of allowing a discount in valuation for the fact that it's inside of a business, which in itself does not have ready marketability. So I think that's that's a very valuable thing that was allowed by taking this not including it in the Green Book.
Yeah, it shows the value of the importance of those lobbying efforts on the part of the financial services and insurance industry on the life insurance and just general planning community around FLPs. This is an area that would have been just a complete mess. So we're going to pivot now and look at the capital gains tax. So let's get into this a little bit more. This is crazy stuff.
This is, and the reason why I lead with this is it is the most troubling of the proposals that are in the Green Book. So where we are is that if a person were to make a transfer of a capital asset, either by gift, and as I mentioned before, if anyone wanted to make a gift and you exceeded the exemptions, you'd be paying this tax at the time of the gift. So this is to anyone other than a spouse. So there's a benefit there to being married, or if it's to a charity, then there would be no capital gains tax that would be triggered at that time. But if it's to anyone else, and there's no mention of a holding period here. So, we're all familiar with well, if I just hold this capital asset for long enough, I won't have a capital gain, or I'll have a minimal capital gains tax. Seemingly, this doesn't matter in this particular situation. And the federal capital gains tax is a really punitive tax. It is 39.6%. So on that example I gave earlier, that one of the people on the call is making a gift to Chris of $1 million. It's really not, because Chris is going to get the $1 million, but you are going to be paying a $400,000 tax. That is a serious tax and a serious disincentive to making the gift. Now there is an exclusion, and so it's a unified one, just like our exemption against the gift and estate tax now. So they say, your first $5 million is sheltered. So if you've made a transfer of $5 million or less, then there's no tax on this. But if you use it during your lifetime, you don't get another bite at it at death, which is exactly the same way as the federal estate and gift tax exemption works. But this is only up to $5 million. The other thing that they copied from the estate and gift tax rules is that it is portable between spouses. So if one spouse doesn't use it all and dies, then it can be used by a surviving spouse. So if you're married essentially you have 10 million of gain exclusion to utilize. So that rule is very similar to estate and gift tax rules. Now you can also defer the tax. This is kind of an unusual provision they put in here, where when it's a gift of a family-owned and operated business. So this was to try to protect the small business, and I sort of view this as a good thing, but beware, because if the value of what you are gifted goes down, in other words, let's say the kids operate the business, but they're not as good as their parents were in operating the business, and the value of it goes down, or their sector just happens to fall out of favor. Well, what happens here? I mean, the end of it is that you're stuck paying tax on that deferral as if it was still worth what it was originally gifted for. But if you're in a business that goes down in value, what are you going to pay it with? So it's a dangerous type of tax. But anyway, that's been proposed.
Yeah. So what I would say,
so that's the capital gain.
As it relates to what would you pay it with, I can't help but chime in on that, John. I mean, this is really an excellent example as to why having proper life insurance in place would be helpful to any of the participants here, because it does provide at least some modicum of certainty, right? So the same issue that creates the tax, the passing of mom and dad, generates the solution in the form of life insurance. So let's pivot and talk about.
Exactly. So it's ensuring the result, right?
Right. Exactly.
That's the key.
The yield wealth tax. This one, I really don't see how it gets administered. I think it just is dead on arrival personally, but it's here. So let's talk about it.
Yeah, it's a serious proposal, and there are a number of senators. This is without a doubt would very easily pass the House of Representatives. It has not yet, but it really hasn't been pushed yet. But there are a number of senators who are, and prominent senators such as Senator Sanders, Senator Warren, Senator Wyden, Senator Holland, who are all very much in favor of this tax. And so it's really kind of a simple description. If your net worth's over 100 million, then there's a new minimum tax on all income and unrealized capital gains, which is pretty amazing. I mean, it's a 20% tax. It does provide for an installment of these payments over 9 years, but it's an annual tax. Mm-hmm. So you'd always be in a 9-year deferral of this tax. So I'm not sure how they came up with a 9-year, but that is what they have done. So you make a payment in the first year and then 9 more, and then the next year you're making a payment in the first year and then 9 more for that one, 8 more for the first installment. So I mean, it really is very, very complicated. And then the question is it even constitutional? My guess is no, because if you really read the Constitution, which I'm 100% convinced nobody does, including people who are supposed to be. But I think if you really read the Constitution, you'll conclude that a tax like this is really outside of the constitutional ability to collect a tax. Let's not forget, it wasn't all that long ago, in 1913, when the income tax was first brought in this country, that they needed to amend the Constitution to provide for an income tax, because nowhere in the Constitution is there any ability of Congress to tax the people other than on items, duties. That's the only thing that was in the Constitution. So they amended the Constitution with the 16th Amendment to allow for it. So, I mean, I have serious doubts whether something like this is constitutional, but we'll see. I mean, it is very popular politically. I mean, I think Senator Sanders' popularity, Senator Warren's popularity is pretty broad, and that populism is, yeah, let's just tax people who have a lot of money. It's, makes sense, right? So
we shall see.
At any rate, we'll see what happens.
Yep. This one here, I got.
So next is,
if I may, John, the GRATs. Defective grantor trusts. I could see them going after those because there's been a perception that they're potentially abusive for years. But the GRATs, I mean, they're codified in the Internal Revenue Code, and it amazes me that they're taking such a hardline stance at them because, it's just such a bedrock of planning these days. But in any event, let's get into the specifics here of GRATs and defective grantor trusts.
Yeah. So thanks, Chris. That's a good introduction to it, because you're quite right. I mean, GRATs have been around for a long time. I've done GRATs my entire career, and before 1990, it was sort of the wild west. We would do private lead trusts, which eventually became GRATs. But private lead trusts are just that. What you're doing is what you're saying is, I'm going to put into a trust an asset, and I'm going to get back what I'm supposed to get back. In other words, I'm going to get a return on my asset, and the asset's going to come back to me if it doesn't go up in value. And if it does go up in value by more than what the IRS going rate is, then whatever's left in there is gravy that goes on to my children. And Congress sort of fell in love with this thing, back in 1990, which wasn't yesterday. I mean, that's, when you think about it, that's 32 years ago. And I don't think that anything that's legislatively created is really an abuse, because It's not like the technique has changed. It's exactly the same as it always was when it was first codified. So at any rate, what this year's Green Book says is GRATs would be required to go for a minimum of 10 years. I don't know where they picked 10 years from, but that's what they pick for a minimum of 10 years. And then they put a maximum of life expectancy of the annuitant, who's the person who's setting up the GRAT in the first place, plus 10 years. So somewhere along the line, somebody thought that 10 years was a nice round number to put on this. And then they put a moratorium on a declining annuity payment. And I just don't understand, why this was put in, other than its intention would be to avoid a reduction in the amount includable in the estate of that grantor who dies before the term. But it just doesn't really, it just really doesn't make any sense, because if I've got a declining annuity, fine, I'm hedging what my result's going to be. So I'm willing to sacrifice some of the better result in exchange for making a bigger gift up front. So I really don't understand where the abuse is there either. But at any rate, and then they would put a ban on the grantor reacquiring the GRAT assets without recognizing a gain or loss. Well, you're going to have to do a lot of mental gymnastics in order to get that, because this is a grantor trust. By definition, can't recognize gain or loss in a grantor because it's a grantor trust. So I don't really know where they're headed with that, but it certainly is part of the proposal, and if it becomes law, we'd have to deal with it. Because for us, what I like to do in planning, and this would be on the next slide, do a zeroed out GRAT, meaning that it's a short term, 2 years, with the mindset of either this asset that I'm putting in is either going to go up in explosive value or it's not.
Mm-hmm.
And if it is, I win. And if it's not, there's no loss. There's no harm to it. So it's all part of a process that we use a series of rolling GRATs. So I've got a GRAT that runs, for a few years or 2 years, and if the asset value does not go up, I just get it all back and we start all over again. Typically, you would be looking at doing this in a closely held business, where the family is running the business, but there's an expectation that it will attract private equity investment.
Mm-hmm.
And the idea here is I've been building this business, and then waiting for that bluebird to fly in the door and give me that the big offer. And this happens. We constantly do this because the expectation is that eventually this business is going to go up in value and we're going to get compensated for it. And the grantor doesn't need it all. What the grantor wants is the base value back. So if we've built up a value of business, say to be $20 or $25 million, and the private equity guys come in and pay us $100 million for it, then the 75 difference stays in the GRAT and accrues to the benefit of the kids on a zero transfer tax basis. That's the ultimate win. And as I like to say, that puts the grantor in the estate planning Hall of Fame.
Sure.
And so that's the type of this is the type of technique it is. It's one of these nothing ventured, nothing gained type of techniques. But I really don't see it as an abuse, because what you're doing is a lot of work into the process, where you're constantly having to value it every year, because we've got to make sure that we're getting back what we're supposed to be getting back out of a short-term GRAT.
What I would let me just interject for a second there, John, as well.
Go ahead.
It relates to these short-term GRATs. This is a perfect strategy for those of you that are on the call today, and I see a couple of you that have used or are using all of your exemption. The term zeroed out GRAT means that there's going to be no gift tax ramification in the way that it's calculated. So it's really a wonderful way for those of you that have used your exemptions or are planning on it to continue to move assets out of your estate in a thoughtful manner. And as John indicated, I mean, you can push the growth out over a certain value, and just by administering these on a go forward basis. And we certainly do that with John and others. And that's really an awesome technique. The expense as it relates to it from your perspective is just the administration, the setting up the documents with John, the administering of them with John, your CPA, and with us. But it's just a really, really valuable technique.
So now would be the time to do them if this becomes law. Definitely do not hesitate, because I still think there's upside, especially for closely held businesses. May also be for the stock market as well, because if you believe that this is the low point, and that the marketplace has already built in a recession, and it's the stock market unlikely to go lower, then if you did GRATs now and you do have explosive growth over the next year or two, then you'd be able to get that exploded growth portion out of the estate with no transfer tax cost.
Right, absolutely. Those hyper appreciating assets that we talk about. So let's talk about defective grantor trusts.
Yeah, so the intentionally defective grantor trust is a technique that did not exist before the kiddie tax. So what happened was, in the 70s and 80s, there was a lot of income shifting because we had a lot more brackets back then. In the 70s, you might recall, well, actually, there's only a few of us that recall it because there's now people who recall things in their 70s are old like me. But there were a lot of income tax brackets back then. And kids would always be in the lowest bracket because they didn't have any earned income. So it was, sort of cottage industry of setting up trusts for kids so that to shift the parents' income, which was at the high brackets, down to the kids who were at practically no bracket. So Congress enacted the kiddie tax and treated the grantor as the owner of trust that they established for the benefit of their kids for income tax purposes, which then of course put all that income that was shifted over to the kids at the grantor's highest bracket. Well, it worked. Yeah, it worked because that was the end of any of these trusts, being set up to shift income. But what it did is it said, well, if I'm going to be treated as the grantor of this trust that I just set up for my kids, then because it's a grantor trust, meaning that it's indistinguishable from me, the grantor, for income tax purposes and for purposes of determining capital gain or capital loss, then I can effectively sell my assets that are capital appreciated assets to the trust, recognize no capital gains tax, and effectively freeze the value of my estate. Well, the Green Book has a proposal here which would eliminate the benefit of a sale that otherwise would have frozen the value of the assets sold to the intentionally defective grantor trust. And this is a little bit more out there than the GRAT, because this really was never congressionally created intentionally like the GRAT was. Mm-hmm. This was congressionally intended. Congressionally created by accident because they were trying to stop what they assumed was a much bigger abuse, and in the meantime created another loophole. You could call it a loophole, but in point of fact, it is what it is. If
they definitely
if a grantor, yeah, they do, yeah, that's for sure. But if a grantor establishes a trust and is going to be taxed on it individually, then, where's the harm here? The asset either goes up or it does not. If it does not go up, then the grantor just receives the value back that he or she put into it. And then there's no upside for the kids. But at any rate, it's a perceived abuse. And so, if you're considering an estate freeze type thing, this along with the GRAT is a good thing to do and a good time to do it.
Yeah, for sure. And I will just add to that there's a slight differentiation if you're thinking about either of these strategies right now, as you think downstream between yourself and your kids, and then if you can think out to your grandkids or great grandkids, utilizing the defective grantor trust. We can allocate generation skipping transfer tax exemption to those gifts, and they can remain in these perpetual trusts, at least assuming that they can continue. We'll talk about that in just a moment. But you cannot gen skip, as we say in the industry, a GRAT. So just know that the assets moving downstream from a GRAT to the kids go to the kids. They don't go grandkids, great grandkids, etc. So a little bit beyond where we're at today, but I think it's important to just bring that up. So let's talk about
that. Really is a good segue into the GST exempt trusts.
Yeah, for sure. These dynasty trusts. So talk us through this, John. So I know that Rhode Island is you guys have repealed the rule against perpetuities, correct?
Yes, that is correct. We have no rule against perpetuities, which means that we can do a trust for as long a time as you want.
Mm-hmm. And in
And
Massachusetts, we still have the rule against perpetuities. So for those of you that reside here, the longest that we're going to really be able to go on that is in the neighborhood of around 90 years. Some people say that's more than enough. Other people say that's nowhere near enough. So if it's nowhere near enough for your tastes, Rhode Island it is, or New Hampshire, or Delaware, or South Dakota, or some of these other jurisdictions.
yeah, exactly. I like dynasty trusts for the main reason that you get to skip generation to generation to generation without having to pay transfer tax at each generational level. And if you have true wealth and a relatively small family, it can work. They become unwieldy when the generations go downstream and you have hundreds of beneficiaries. But if there are a reasonable number of beneficiaries, say less than 100, I think it can work out pretty well in multi-generations. I have a few that are going now that have around 100 beneficiaries, and it still works. I've had several that disintegrated once we got to the third or fourth generation, where we had several hundred beneficiaries, all with disparate interests and not enough assets to justify it. But for the most part, I like to create a family bank, and this is a very effective way to do it. But the Green Book proposal would limit the generation skipping exemption to only 2 generations below the grantor, meaning just the children and the grandchildren, and not allowing it to be extended to the great grandchildren or beyond that. It's a pretty draconian proposal, and this one is retroactive.
Yeah,
so you can't do anything to plan for it. But
would be bad.
But it would be bad if this were to happen. So a few other things that are in here, and I'll just quickly go through these, is that for farms and ranchers, this is a valuable thing because the special use valuation reduction, which is currently $1,230,000, would be increased to 11.7 million. So this is actually a good thing, but it's only good for farms that would be, in very, very valuable areas. So in Massachusetts, in Rhode Island, there are farms that are literally on beaches. And in situations like that, this is where it would be very useful. So I have a few farms that are waterfront. The properties are literally on the water, on the beach. And, if those were to be valued for, high-end houses and things like that, it would be much, much greater. So this is actually one good thing that's in here.
Mm-hmm. For sure.
But it's a very narrow application. The other thing that's in here is we went a little bit faster on the slides. But that's okay. But yeah, that's okay. We'll just quickly touch on there's a 10-year lien on estate and gift tax that would be due, and it would be extended automatically if a taxpayer entered into a deferral or installment payment plan for the tax. We do this all the time, tax deferral and installment payments on closely held businesses. This is the IRS's answer to the issue that they think that taxpayers are getting away with disposing of some of the property that would secure the payment of the tax. I've never seen this happen in 37 or so years of practice. I have never seen this happen where a taxpayer defaulted on a deferral on an installment payment but I guess it's happened somewhere, and so that's what the what this is targeted at. And then the last one that's here is really unnecessary under any circumstance. I think if you had a trust and it was worth over $300,000, well, first of all, why would you ever establish a trust for assets that were worth less than $300,000? It just doesn't make any sense. But they'd require to file with the IRS essentially an annual report stating the name of the grantor, the trustee, the tax ID identification number, and an estimate of the value of the trust. I see no reason why this extra layer of administration would be brought in, because all this information is already reported on a 1041 to begin with. But at any rate, that's what's there.
Yeah. So where does this?
Let's go into. Go ahead, Chris.
Yeah. No. Where does this take us? I mean, obviously, as we've been talking about, there's a lot of these things that are aspirational, I would say, and what are your thoughts about this any of this actually coming to fruition?
Yeah, sure. I mean, as always, it's anyone's guess, and politics are very fluid. But just you sort of look at the political reality, right? So Democrats control the House, but not by a lot. It's only by 8 seats. So if they lose four votes, then nothing passes the House. Because I can absolutely guarantee you there's not a single Republican who will vote for any of these proposals. That's for sure.
Right.
The Senate is 50-50 as everybody knows. It's famously been reported by the media over and over and over and over again. But Democrats are in control because Vice President casts a tie-breaking vote, of course. But here's the big thing: she does not have a vote. It's not like she has a vote. She doesn't have a vote unless it is a tie. So if any Democrat votes no, then nothing's going to pass the Senate, and it's really that simple. And the media likes to point to Senator Manchin, and Senator Sinema to a lesser extent, but the two of them are not the only ones. There are other Democrats who are not in favor of these provisions too. So, and you can bet your bottom dollar not a single Republican is going to vote for any of them. So, I don't really think this is a likelihood of happening, but I mean, there is a possibility, I guess, that you could have some sort of a compromise. So if you look at it as as not an overriding motivation for a bipartisan compromise on this stuff, because I honestly think that if there is going to be a bipartisan compromise on anything, it's more likely going to be on gun safety as opposed to taxes.
Mm-hmm.
But we'll see what happens. And the other thing that's important to note is that to stick with the same gun analogy, is that there's no gun to the head of the Congress right now, because they've already passed a reconciliation funding the government through the end of the fiscal year. So there's not going to be any crisis, because in October, with the entire House and 1/3 and 2/3 of the Senate up for re-election, they're all going to be campaigning in October. So I really don't think it's going to happen this year. But there are a few things that I think there are maybe room for a bipartisan compromise. I think the biggest one is the possibility of just keeping the estate and gift tax exemption where it is, and just jack up the rate of tax. We've had graduated estate tax rates before. We don't now. It's a flat 40%, but we've had them for many years where states, as they got bigger, paid a greater percentage of the size of the estate in tax. So you could easily say, well, if we increase the marginal rates, maybe start at 40 and work up to say 60 or 65, you'd be raising a lot more revenue, and you'd be raising the revenue from, sort of the people who have estates that could afford it the most. So I think, there's really room for that type of compromise. They could restrict some of the benefits of GRATs and intentionally defective grantor trusts and family limited partnerships and bring back carryover basis. But those are all movies that we've seen before, and they're not as effective as increasing the marginal rates. So I think that's probably where the compromise ends up coming up in the future. So and I know we're really long on time right now. So I think we should just wrap up with what should we do right now? It's sort of, as I see it, is get those life insurance trusts in place and fund them, and allocate that generation skipping transfer tax exemption before that's a possibility to go, or be limited, and get those in place, because that's still the best game in town to create long-term wealth for families that have some liquidity, maybe don't have the ability to do GRATs because maybe the senior generation still needs the assets to produce for them. But for those that don't, and are sort of satisfied with the wealth in the senior generation, definitely do a GRAT if you have a closely held business. And then on appreciating assets even more so, I would do an intentionally defective trust in exchange for a promissory note to effectively freeze the value of your portfolio as it is right now, especially for those people who believe that, hey, look, the stock market is down a little bit. I wouldn't mind freezing that low value in my estate, and then watching the rest of it accrue to the upside accrue to my family in the future. So that's generally the to do right this minute.
Great stuff, John. Well, thank you again. We are a little bit long. I'm sure we'll have some questions. And by all means, please reach out. As I said, I'm going to try and get back to the back here. Just going to bang through a couple of slides and hopefully get to our contact information. So here we go. Again, John Harpoosian, 401-455-9800, and Chris Cahill, 978-318-9500. Thanks so much, John. Really appreciate it. Great job as always. Estate planning in uncertain times. That's what we're in, folks. There's a lot to be done. Please reach out. Be well, be safe, and we look forward to talking to you all soon. Thanks.
Thank you.